Good morning everyone and welcome back to Morning Markets here at True Potential. I'm Kevin Kidney and today we're going to focus on bond markets. What is driving further weakness, that is higher borrowing costs, and the impact on broader asset prices such as equity markets. So we've spoken considerably over the last 18 months about bond markets and the impact of higher yields further afield. Last year, higher yields were being driven by central banks raising interest rates in reaction to inflation. This year, despite falling inflation and despite rather moderate inflation expectations, markets are focused on further inflation pressures, such as those that could potentially come from the oil market or from relative US growth strength. So let's dive into a bit more detail about bond markets. We're seeing 10-year highs on borrowing costs for governments in Germany and France, and also for Australia and New Zealand. So it's not just a UK and US specific problem where we've got 15-year highs on borrowing costs here and also in the US. It's really a global phenomenon where markets are worried about further price pressures coming from the oil market. And that was referenced in our podcast last week. This week, the market is reacting more to the update from the Federal Reserve last week. That is, the Federal Reserve put through a rather bullish suite of upgrades to GDP for both this year and next, whereas they had previously referenced the likelihood of a recession or recession-like outcomes potentially through the start of next year. They have done away with that, and they now expect much lower unemployment through both this year, next year, and that's as a result of much higher growth. So that higher growth in the US versus the rest of the world, and also the higher oil prices we're seeing for both Brent and the US market, is worrying bond investors that central banks, whilst they might not be forced to raise interest rates further this year or even next, they may not be able to cut as much as markets had anticipated through the summer. So markets are often forward-looking and had thought that we may see substantial rate cuts globally from the summer next year and really bring down those borrowing costs, not just for government, but also for corporates and for mortgage holders. However, the signal, mostly being influenced by the Federal Reserve in the US, is that rate cuts next year are increasingly unlikely. And that's because mainly just of the growth picture in the US. Recall that Germany is in a technical recession. The UK continues to flirt with growth near zero. And we're also seeing poor growth outcomes in places like China. And this really does matter for global bond markets. So in summary, it's the oil market today, this month and last month, which is worrying bond investors, but also the likelihood that central banks are just going to be far more rigid in holding rates where they are. It's not about higher interest rates in the future. It's just likely that rate cuts won't come through. And that's what's impacted equity prices at the moment. It's just causing weakness further afield, and even in places like the sterling market, which again was referenced by our CIO, Jeff Casson, on the podcast last week. So that's all for today, but please do join us later in the week as we'll talk more about inflation in Europe, and then at the end of the week, an update on inflation in the US. Thank you.